In this podcast, Pepper partner Greg Nowak is joined by Myles Edwards, who is General Counsel, Chief Compliance Officer, and Chief Operating Officer at Shufro, Rose & Company. He's also joined by Irshad Karim, General Counsel at Lion Point Capital. Mr. Nowak leads a discussion on fund expenses, including recent SEC initiatives, fund due diligence, cross trades, the recent FinCen Proposal to extend AML reporting to RIAs and their funds, and the outsourced CIO. Is this a megatrend or a fad? We hope you find this podcast interesting.
Today we're going to focus on issues that are of particular interest to family offices and similar investors who are in the marketplace looking at alternative investments and general investments. Today I am joined by a good friend of Pepper Hamilton and of this program, Myles Edwards. Myles is the General Counsel, Chief Compliance Officer, and Chief Operating Officer of Shufro, Rose & Company here in New York. And also Irshad Karim, who's Counsel and Chief Compliance Officer to Lion Point Capital. So, Myles, if you wouldn't mind just saying a few words about your firm and your practice.
Sure. My name is Myles Edwards, and I'm General Counsel, Chief Compliance Officer, and Chief Operating Officer for Shufro, Rose & Company, a firm that's been established in New York since 1938. We're a wealth management firm, and primarily we invest for ultra-high net worth clients and certain other types of institutions, and a portion of our asset allocation is devoted to our alternative products.
And Irshad?
I'm Irshad Karim. I'm responsible for legal, compliance, and regulatory affairs for Lion Point Capital. We're basically a hedge fund manager. The strategy is special situations, event-driven. And as I said, because I'm responsible for legal and compliance matters for a hedge fund manager, I regularly deal with hedge fund topics and operational due diligence questions by investors.
So as we were preparing the agenda for today's program, we were trying to figure what topics are not necessarily hot on everybody's consciousness at the moment, but nevertheless are oldies but goodies, things that all of us in our respective firms and practice areas contend with. And so we came up with 5. And certainly if you have any questions that you'd like us to address that are related to these topics, please feel free to submit them. We always enjoy an interactive program. But our topics today are fund expenses, fund diligence from a legal point of view, cross trades, the recent FinCen proposal to extend the anti-money laundering requirements to registered investment advisors, and a hot topic in the high net worth and family office arena, outsourcing of the Chief Investment Officer role and function. So without further ado, let's turn to our first item, which is fund expenses, and that can be found on the slide that says fund expenses at the top, number 1. We've seen a extensive SEC focus in this area, and it has come out of the Dodd-Frank requirement for investment advisors to private funds over certain dollar thresholds to register. We've seen a lot of SEC emphasis in the private equity area because there you have a variety of different fund flows that have caught the SEC's attention. So, for example, there may be monitoring fees. There may be portfolio company management fees. There may be portfolio company monitoring fees. And a whole host of others that are paid by the underlying portfolio companies, and depending on the transaction, they may or may not be offset against management company fees. And then, of course, at the fund level, there's the management company fee that's paid, but there's also a carry that's paid based upon the profit attributable to the disposition of certain investments, and how those profits are computed with clawbacks and other moderators with respect to the return of the general manager or the manager of the particular fund. The SEC has uniformly been critical of the industry in how it discloses the fee arrangements, and has also been critical with how certain expenses of allegedly of the manager have been allocated to funds, and whether or not there has been necessary disclosure. So I'm going to ask Irshad to comment a little bit on what he has seen in terms of how his business has changed with respect to expenses at the fund level.
Sure. Thanks, Greg. So the Blackstone case for me, and you set it up very nicely, I mean, the SEC has been beating this drum for at least a year and a half, famously Drew Bowden's May 2014 Spreading the Sunshine speech, where he specifically focused on private equity fees and expenses for private equity managers, and where he threw out a statistic. He said that 50% of PE managers that we're looking at were deficient in the fees and expenses category, and I think that shocked a lot of people. So when you look at this recent Blackstone case, it's essentially in that line of cases. And we've seen some high-profile managers, KKR in the spring, now Blackstone. KKR was in the co-investment area. In the Blackstone case, they are these monitoring fees. What's interesting is in the allegations, it was clear that Blackstone had disclosed the existence of these portfolio monitoring fees. And just to quickly spend a minute to describe what that practice is any time that Blackstone made an investment in a portfolio company, typically they would charge the portfolio company a fee, typically 1% or less, annually for up to 10 years, which coincides with the length of the fund typically. And that monitoring fee would be collected every year by Blackstone as the manager to monitor its portfolio investment in that company. They further disclosed that in the event of a IPO or sale transaction, that they might accelerate those fees. However, the SEC found, and they brought this case as both a disclosure case and a policy and procedure case, that the disclosures by Blackstone were not sufficient. Now, I think to Blackstone's credit, they did a lot of good things. When the SEC first came out and started talking about fees and expense issues, they actually went back to see what their practices were. And this was one of those practices that they decided to stop engaging in right around 2011. So bear in mind that Blackstone got hit with this nearly $40 million fee for basically historical practices. These are not practices that the SEC came in and found that Blackstone was currently engaged in. They stopped it essentially on its own accord and went in and told investors that they were no longer going to engage in this practice. Furthermore, they were providing fee offsets in many cases for these portfolio monitoring fees. Nevertheless, the SEC didn't like the fact that these fees were being charged, and their allegation was that many investors simply weren't aware, in this particular instance, that these 10-year fees, that if there was an early IPO or M&A transaction, that there would be an acceleration in either a lump sum payment made or some kind of accelerated payment made that would be truncated.
Okay, so let me stop you there for a second and turn the mic over to Myles. Myles, you're an asset allocator. You work for an asset allocation firm. You represent high net worth individuals. And you're very good at what you do. Is there any realistic possibility that similarly situated investors were not aware that these fees were being paid?
Well, I mean, it's a possibility. I mean, we always have the issue of transparency whenever we work with any sort of private fund, because the level of transparency, I have to say, in some cases, unfortunately, is not as high as you're going to find in the registered fund environment. So I would say possibility does exist. Now, for us as an allocator, we're really the first line of, I'm not going to say necessarily defense, but the first line of introduction between the private fund manager and our clients. And what we do is we do a very robust operational due diligence. And as part of that due diligence, it's not only looking at how that specific private fund is structured, but it also looks at the terms of engagement. And so we pay a particular close attention to fees, and not only how the fees are represented in the private placement memorandum, but we also drill down and we want to understand for example, with the management fee, what that actually represents. The management fee, theoretically, and I don't know if the rest of my panelists agree, should only be used for the support of the fund itself. It's not a profit center. The profit center is the carrier of the performance fee. So we look at the management fees and we determine whether legitimate funds expenses are being assessed to the investors or are other fees and expenses that may be those that benefit the general partner rather than the limited partners are being assessed. So for us, we take a different view of fees, but I think it's extremely important in order to sustain the long-term relationship that we have with that private fund manager.
Now, it's an interesting observation. I think certainly I, as a member of the panel, would disagree that management fees are not a profit center. I do think that if you turn the clock back about 8 years, it was just the opposite. The management fee was pristine. The manager got his 2%, irrespective of whatever expenses were incurred, and all expenses, including those that were generated because of this particular investment or investment style, were borne by the investors. And, yes, the manager had to come to the table with his toolbox, and he had to pay for that out of his 2%. But, the 2% is what he used to turn on the lights, put food on his table, send his kids to college. And it was his profit center in terms of how he ran his business. The carry is, or the performance allocation is a share of the profit. Either you believe that the manager is, or the general partner is a partner in the firm or not, right? And if he is a partner in the firm, the law forever has allowed us special allocations among partners to move profit from one group of partners to another. And so, those special allocations are not properly viewed as expenses of the firm, but rather a share of profit attributable to one's ownership stake. For those of you who are a fan of this program, you know that last year Pepper Hamilton did a report with PFI that focused on various expenses incurred in the private equity industry and how those expenses get allocated between the manager and the investors in the fund, represented by the fund entity itself. And it was obviously not a scientific study, but nevertheless, the information we gleaned from it was a real eye-opener because there was no consistent undertaking by the industry to move the expenses in a certain direction. And it truly was an exercise in transparency and disclosure. Did investors understand what they were getting? But at the end of the day, the question becomes, is this a proper allocation of SEC resources to be investigating investment decisions made by high net worth individuals who are ably represented by brokers, lawyers, and their own investment managers, right? Number one. And number two, what ultimately is to be gleaned from this other than large enforcement penalties against someone like a Blackstone because they can afford it? And is that, essentially what we want our SEC to be doing? The mantra of the SEC from its earliest beginnings, and William O. Douglas, was open up the drapes and the windows and allow the sunshine in, right? So that the light of day will expose all of the nasty things that are going on, and they will all scurry for cover, and only what is good and shining will be left, right? I guess what we're saying is that those old sunshine rules don't apply anymore, huh? One of the other interesting things about the Blackstone enforcement action that came out was they got dinged for having a much greater discount on legal fees at the manager than at the fund. Now, you know exactly how this happened. Somebody said, well, you can continue to do the fund work, and because that work is being paid for by investors, it's, rack rate or slightly less. And then the work that's done for the advisor is significantly discounted. If that was intentional and they have issues to that effect, sounds to me like there was a breach of fiduciary duty there, right?
To me, the legal fee discount is much more clear. That this was, they didn't allege breach of fiduciary duty. What they alleged, again, was a disclosure failure. But I do think that the SEC rightly found troubling Blackstone's practice of negotiating a higher fee discount for itself than it did for their investors. And they didn't name the fund, they didn't name the level of the discount, and they didn't even say how much of this $40 million fine went to this bucket as opposed to the monitoring bucket. But to me, as a legal and compliance person, to me it's a black and white issue. I don't see how one could, with a straight face, say that negotiating X percent fee, that any sort of differential, if there should be a differential, it should be in the client's favor and not in the manager's favor.
Yeah, but that's 20/20 hindsight. I mean, it's very possible that these were projects and the parties had negotiated specific fees for projects as opposed to, a differential discount. Now, I will tell you, we have seen this happen in other industries, such as the accounting industry, where an uninformed accounting firm would say, well, if you give us the fund work at full rates, we will discount the advisor work. So it's not just limited to the legal fees. All of your professional relationships, custody relationships, brokerage relationships, soft dollar relationships, legal fees, and accounting are all susceptible to this focus, right? And you need to keep in mind that really what they're getting at is a breach of fiduciary duty. And were they trading on the investor's back to get a better deal for themselves? Myles, do you have any thoughts on that?
Yeah, this gets back to, it seems like we're still in the situation we were a year ago where transparency is really a bargain for type of term, and it doesn't necessarily have to be that way. And I think that we still are going to see situations where we have really pronounced conflicts between the general partners and the limited partners. And I think one of the ways that this can be resolved is with really more than less transparency. And I'm not saying that the PPM should look like a mutual fund prospectus where it's 140 or 50 pages, but I think that there's no standardization with the PPM. A lot of them look the same, but I think that fund managers should take extra effort with their counsel like Pepper to have sections which deal directly with transparency itself.
Well, on that, let's switch to topic 2, which is fund legal due diligence, what investors need to look for. And after this slide, you'll see a few slides where we have included a checklist that we use to do legal due diligence for a number of our endowment and other nonprofit pension plans and clients, where they have asked us to take a look at, from a legal point of view, an investment fund that has been recommended by their consultants or investment managers. And one of the first things we do is we compare the ADV of the manager, general partner, to the fund. And so, for example, if the manager has failed to tick the box and have its general partner of the fund listed as a relying advisor, that is a huge red flag that they either don't understand the rule, haven't spent the time or made the effort to understand the rule, or are ignoring the rule that the general partner is an advisor and should be listed as at least a relying advisor with a procedure that the SEC established specifically to address funds. So that's sort of an immediate legal red flag for us. Has the manager at least met minimal requirements? If we're working for an ERISA account, the next question we have is, are they truly a QPAM? So show us your net capital that you have. Demonstrate to us that you meet the AUM requirement. Show us your ERISA bond. And then the last thing we ask is, are you actually a registered advisor? And that takes us full circle back to that first comment that the relying advisor, the general partner who actually has legal control of the fund, if you're going to claim to be a QPAM, you better be focused on everything and be able to tick all those boxes or have a good explanation why not. Special fees. You'd be surprised how often the PPM of a private fund will list fees, especially private equity funds like the ones we were talking about earlier, but the ADV makes no mention of them at all. No mention of them at all. And what we find is that with, of course, this is not the main, this is the exception, not the rule, but we'll often see private equity managers where the fund is very clear and well documented and heavily negotiated, but the ADV is a generation or two behind. Whereas in hedge fund world, we seem to see the opposite, where fund documents may be vintage. They may be 3, 4, 5 years old, which of course is a red flag in and of itself. And whether or not that's appropriate is a different question. We're not talking about that. But the ADV tends to be updated. So, Myles, what have you seen, again, as an asset allocator looking at these funds?
Well, I mean, I've looked at a lot of different things. I mean, generally, I mean, I like your fund due diligence checklist. What we'll do is we'll do something a little bit different, whereby we'll go and we'll ask for their due diligence checklist. Usually it's an AMR type document, which they're going to provide us. And then what we'll do is we'll take that and we'll compare it with all their fund constituent documents. And then we'll also fill out a fund due diligence checklist as well. We want to go first on the representations that the managers provide us. Then we're going to look at the fund documents, the constituent documents. Then if we can find any other information from public sources, then we'll go there.
You know, one of the interesting things that we've wrestled with is the bad actor disclosure. After the Dodd-Frank Act, if you're a bad actor, you can disqualify the firm, right, depending on when the bad actor act happened and the adjudication happened. But we are seeing firms that either don't appreciate that when they get that cease and desist order from a state securities regulator, that potentially makes them a bad actor and needs to be disclosed and could very well disqualify them from doing a Reg D offering, right? And so you still have people who say, well, I don't have to file in the States, or it's irrelevant to me, or we just don't do that, in which case you say, well, if and when you get that cease and desist order from the state of Idaho, you will be a bad actor and therefore precluded from engaging in a Reg D offering. That usually causes them to rethink their activities in Idaho.
Yeah, and Greg, an important part to note is I believe part of the bad actor is that if you're more than, a 10% beneficial owner in the fund as an investor, you also have to fill out a bad actor. So it's important to know when you're coming in as an allocator what percentage of the fund you do represent.
Well, absolutely. And, one of the things that we now have built into our standard subscription package for private funds is a whole bad actor questionnaire for principals of the manager, general partner, and, of course, anyone who's more than a 10% owner in order to 20% owner in order to elicit that information. So I think it's a very important consideration, and it's the type of thing you have to ferret out by digging through the ADV and the schedules on the ADV, the Part 2 disclosure, and even into the PPMs. But what it means is that the stakes of, quote-unquote, taking a position on a regulatory matter are much higher. Because if you take a position and you turn out to be wrong and you get an adjudication against you, it's not like you pay a fine and you move on. It now potentially precludes you from being able to operate your business. And so even if you have a legal opinion from your law firm that says, oh, no, that's fine, that won't necessarily absolve you of a cease and desist circumstance. And so you almost have to be right. Otherwise, you are out of business. Special brokerage arrangements, where you have brokers providing more than just 28E research, but other types of services that are being paid for with soft dollars or otherwise. I mean, this issue has been around for 15 years. I think it's probably been talked to death, but where it raises its head is when you're dealing with private placement arrangements and you're dealing, especially in private equity, where the underlying fund may or may not, or not the underlying portfolio company may or may not be paying a brokerage fee to the fund or the manager for the placement of its securities when they sell it out of the fund. And we've seen those where someone attempts to say that's a management fee, and of course it's not, because they're getting paid transaction-based compensation, and they're not a registered broker-dealer. So you need to make sure that activities that would otherwise be construed as a brokerage activity are being done by people with proper license. Principal trading. Section 206(3) of the Advisors Act prohibits it unless you have certain disclosures and pre-approvals before the transaction happens. We're going to get into a form of principal trading in a moment, which is cross-trading. But oftentimes, especially where you have a firm that has both an advisor and a broker-dealer as affiliates, or maybe even one entity that's cross-registered, there will be in the ADV specific disclosure about their principal trades and principal trade policies. And I have seen circumstances where advisors attempt to get blanket pre-approval of principal trading, even though the rule doesn't allow that, except in a very narrow cross-trading circumstance. So the point is, the ADV Part 2, and the PPM of the fund should be consistent, number one. They should tell the same story, number two. It should be possible to glean from reading those two documents what business they're in and how the firm operates its business, and whether or not you're dealing with someone who likes to chisel around the edges or embraces regulation. And unfortunately, in our current climate, embracing regulation is the appropriate answer. Anything to add on this before we move to our next topic, Myles?
No. I mean, generally, there's a lot of discussion about cross-trading. Most advisors are not allowing cross-trading just as a matter of policy. But it's very important because if there's one area where there's conflicts, it would have to be cross-trading, especially, as you know, if both parties are related to the same party. So we don't see as much, I think, cross-trading in an advisory situation as we once did because it's considered something that's only done when necessary.
Okay, which brings us to our cross-trading topic, item number 3 on the agenda, and we're a few slides in beyond the due diligence checklist. So, why should you care? What is a cross trade? And you'd be surprised at how silly some market participants become when they attempt to define what is and is not cross trades. The archetypical AOK trade is manager says, I want to move stock in company X, which is a marketable security, and is registered in the market, out of Fund A, and they sell it into the market. And then, sometime after that, they buy it in Fund B from the market. That's not a cross trade because the market has absorbed both legs of the trade. Ideally, you have different brokers executing the trades for whatever the then market price is. But invariably, managers, in an attempt to shave points or, quote unquote, get a better deal, attempt to circumvent the market, and they go to one broker and say, I'm going to sell over here and buy over here, and you're going to get paid your commission, but you don't even have to put it into the market because I don't want to move the price, and we can do it at this, average between the bid and the ask. It's that participation by the manager that gets the issue into the forefront. And once you involve a broker between the two parties, and the broker, it's only one broker, and he's receiving a commission, the question becomes, have you breached a fiduciary duty on either side? Now, Section 206 of the Advisors Act basically says that if the advisor is acting as a broker, there's an issue. But if the advisor does not receive any compensation for the trade other than his normal advisory fee, believe it or not, the SEC has actually determined in a release that that is not acting as a broker. And if you're not acting as a broker and you have no other proprietary interest in either of the accounts, 206.3 doesn't apply. You still have disclosure under 206.1 and 206.2, but you don't have the prohibition unless another rule applies. So where could these other rules possibly come from? Well, they come from two spaces. They come from ERISA, and they come from Registered Investment Company World, the 40 Act. ERISA, unless you meet a very, very, very narrow exception, does not allow cross-trading. The cross-trades would have to be essentially between an ERISA account and another account where you're using model portfolios or index funds, and then you have what's called a prohibited transaction class exemption that the Department of Labor has issued to exempt those trades. But if you cannot meet the very narrow circumstances, you can't cross with an ERISA account. Registered investment companies, RICs, on the other hand, generally allow it as long as you comply with Rule 17A7 under the 40 Act. And there the main issues are pricing and no brokerage commission. And so you may be in the position where the advisor has to rebate the commission, go to the board, get everything ratified after the fact, and hope and cross your fingers that on examination they don't raise an issue about it. The best answer is know what Rule 17A7 is before you do it. Rule 17A7 was designed for the movement of securities inside a complex, right? But if you have to involve brokers or you have to otherwise pay commissions to get things done, it's unlikely that you're going to be able to meet 17A7, and so therefore you're back to avoiding it through a normal trade. The disclosure required in cross trades is very, very, very complete, and it's more than high level. You actually have to get consent, and you need to make sure that you can fit into one of the general parameters. Myles, in your asset allocator role, when you see a cross-trading firm, what's the first thing that goes through your mind?
Well, I like to know a little bit more about it. I think it's legitimate to know the facts and circumstances that belie that transaction. I think the most important thing is really frequency. One or two, okay, I see 20 or 30. I think there's a reason to be concerned. So I think it's only used on an exception basis. And I would like to know the policy, see the policy. I'd like to see whether it's disclosed in the ADV and really the circumstances that belie those types of transactions.
So let's talk about, different forms of cross trades. If you flip the slide, we have option number one. And this is, cross trading in its purest form. The RIA sits between two accounts, probably custody accounts, and it's moving stock of one company from account A to account B in exchange for payment of money from account B to account A. And the price is determined by the RIA, probably at the midpoint of the day between the bid and the ask, or maybe the midpoint at the close between the bid and the ask, depending on when the trade occurs. Generally, this could work, provided that it is not an ERISA account on either side, and further provided that no one receives a commission, and further provided that neither account A nor account B is a registered investment company under the 40 Act. So very important considerations. The archetypical cross-trade can work, has to be disclosed. You have to comply with the SEC release. There cannot be a commission paid, and you need to get the 2061 and 2062 disclosure out to the clients. Any comments, Irshad, on this particular picture?
Well, I just want to note, sort of as a general observation, that yes, it's correct to say that cross trades, that the existence of them may throw off a red flag. But in the private fund context, I've seen ready acceptance of them in one scenario, and I'll describe it just so that there's some practical context for it. And that is where you have Fund A and Fund B, or Fund A and Managed Account X, that run a pari passu strategy. And because of monthly inflows and redemption, those strategies that are being run on the same basis, but the pot of money that's being deployed may go out of whack. So you have what are called rebalancing trades. And it's to affect those rebalancings and to make sure that the pari passu strategy doesn't result in tracking errors between those two funds, that you engage in these month-end cross trades. And the cross trades, as you point out, a conservative manager may actually cross them in the market. And as you correctly point out, it's not really a cross trade because you've worked it through the market. But another acceptable manner that I've seen these being done to minimize the fees and therefore the cost to the fund investors is to cross them sort of on a journal entry basis in the general ledger, but having a preset mechanism. So you know that on the opening of business, at this price, you will cross the trade, and there's no override on it. So there's no kind of putting your finger on the scale to favor Fund X versus Fund Y. It's just preset, and it automatically, that's your methodology for crossing.
See, now, the problem, and of course the risk associated with these, is that Fund A or Account A is an active account and has a investor who's very focused on what's happening. Fund B is your traditional sleepy account that no one really pays attention to. They just collect the checks from it. And so what ends up happening is the manager attempts to stuff bad stuff out of Fund A that people are screaming about into Fund B where people are more quiescent. And so you end up with Fund B holding all of this crud purchased at a price that was not transparent because it's not at the market. Especially a problem when you have illiquid securities that are not being traded in an open market. So that's the archetypical bad boy cross trade.
Correct.
Right? And
that's the abuse you want to avoid. But what I'm giving you is sort of at the other end of that spectrum, a perfectly good scenario where investors understand why it's being done. And there's really no abuse being done. These are, readily marketable liquid instruments being traded at a market observable price on a preset date for rebalancing reason.
But how do you do the journal entry? Presumably these accounts are being held by qualified custodians, so the money has to be moved, or the assets have to be moved out of one account into another.
No, they could be PB'd by the same, or if it's a managed account.
PB, prime broker.
Sorry, prime broker.
Right.
But yes, with a managed account, you could have, it could be Goldman or JP Morgan, could be the custodian for both.
But where they're not the custodian for both, it would appear to be much more difficult, and you'd probably have to go through a market trade, I would assume.
Yes.
Because once you have different market players...
Yeah, you are moving securities. Exactly. You actually are moving securities.
And that becomes more difficult.
Correct.
So if we turn the slides and go to option 2, this is sort of a variation on the first theme, where we've actually interposed a broker, and the broker is acting on a principal basis, but essentially a riskless principal basis, or on an agency basis where the parties have been identified as well as securities. And this is the one which I referred to earlier as the chiseling transaction, because the RIA has decided that they need to have, someone in the middle to facilitate the trade, perhaps because we're going between primes or something like that. And they only want to pay one commission on the round trip, so they have one broker do the trade, and then they tell the broker the price. And they assure the broker that you will not have any risk because the taking of title of the security from account A will immediately be offset by the delivery of the security to the account of B. What about this trade? On its face, it appears as if the RIA has done something good, right? It has engineered a transaction that avoids double commissions, and it's fair because it is the midpoint price between the two trades.
Yeah, and what I would say, Greg, is that this is something that I think we would feel comfortable with. Again, this seems to have a legitimate financial and economic reason for it to be done. And so I'm not saying that I see more of these types of trades, but it makes perfect sense that this is the type of trade a manager would execute.
And it's fine. You're absolutely correct, as long as neither account A or account B is ERISA. or as long as neither account A or account B is a registered investment company. As soon as you interpose either of those facts, this transaction becomes a problem. And the only transaction that works under those circumstances is option 3, which is where we have two brokers, the market interposed, commissions all around. Now, this is one of those examples, I guess, where no good deed goes unpunished, right? Because here we are trying to save our clients money in the prior model, and the regulators are saying, no, there's really no assurance that you've actually saved anybody anything. The only assurance we have is if it's truly the market price. I think it's always useful to go through this exercise with compliance officers and with traders to remind them as to when and how cross trades can get you into trouble.
Greg, let me ask you one question. I personally have not had this direct experience, but where one of the accounts, one of the funds, is a principal fund because the ownership by the manager and its related person exceeds 25%. So in that circumstance, the SEC views that as a principal fund. And so if you have a cross trade between Fund A, which is a principal fund, and a Fund B, is that a principal cross trade, and how would one get consent to that?
It's not even a cross, it's just a principal trade under 206-2063, rather, of the Advisors Act. And it can be done, but you need to get the approval of the investor on both sides beforehand.
Right.
And you have to disclose the price and the amount of consideration you're receiving in exchange for the service being rendered.
So I think in most circumstances that would be impractical.
Well, it depends. I mean, if it's an illiquid security, let's say,
sure,
and you're moving it out of one private equity account into another, and one of the accounts happens to be a proprietary account, which, by the way, if you have a 20% carry, get close to that very quickly, okay? Because you now have a 20% interest in the account. If you're moving it out of an account like that, the disclosure to the investors that says, now remember, most private equity investors tend to be very activist anyway. And so there will be less of a absentee landlord problem that you might have in some other fund. And I think I have seen circumstances where we go and we disclose and we get the investors' approval.
I think in private equity, I could see it actually being easier, even though there are liquids, because you have the time factor in your favor. But in a more dynamic, faster hedge fund world, where you're trading securities every day and multiple times, it would be impractical to interpose a pre-consent.
Well, it's easier now with electronic transmission, where you could get pre-consent from the investor. This issue used to come up all the time in structured finance world back before the market crash, where a manager would assemble a warehouse and have several $1 billion worth of securities that he has assembled in a warehouse using a line from a bank, and then he's going to transfer the assets from that warehouse into the final securitization vehicle once it's been funded by the investors. And, remember, the manager in many of these deals used to hold a significant contingent interest, namely the residual equity piece. And if it didn't hold it, it would have a carried interest that was not insignificant. And those arrangements, when you raise the principal trade issue, how are you getting it out of the warehouse and what's the price? The investment bankers used to go into reset mode and say, how can this be? What do we need to do here? And invariably everyone would just get the consent. But that's one of those instances where people just don't focus on the fact that 206.3 does apply, and the manager, the collateral manager who is managing the warehouse and also is managing the ultimate securitization vehicle, is selling assets from one account that it manages into another. It's an archetypical principal trade. So you always have to worry about that issue. But cross trades, again, one of those oldies but goodies. It's something that you should not lose sight of. It's there, and we have to deal with it. If we turn the page to item number 4, the recent FinCen proposals on anti-money laundering, the program we did last month in September was a full-blown program on the FinCen proposal, but we're just going to do a quick highlight of it here. And the principal fact that you need to focus on is, are you a federally registered investment advisor? If you are a federally registered investment advisor, the FinCen proposal will apply to you. If you are not, if you're exempt, the FinCen proposal does not apply to you in its current form. There was some suggestion that they may focus on large state advisors, or they may focus on other exempt advisors, but at the moment, the dividing line is federal registration. So, let's assume that the AML proposal is adopted. What will you, as a family office, multifamily office manager registered as an RIA, have to do? What would you, as an asset allocator for high net worth families and individuals, have to do? At a minimum, you need to have an AML program in place. You need to file currency transaction reports and maintain the records. You need to monitor the accounts and the transactions, and you have to file suspicious activity reports when appropriate. Those of you who have been around the industry for a while know that Treasury had proposed back in the early 2000s that the Bank Secrecy Act and all the requirements of an AML program be extended to asset managers. And the industry at the time argued successfully that these would generate nothing but duplicative reports, that there was no reason for asset managers to do this because they never touch money. The money is always at a bank, a custody bank, a trust company, or at a brokerage firm. And so therefore, how could they even be in a money transmitter business? Or since they don't have custody, how could they even file an SAR? I don't know if that argument, duplicative reporting, is going to carry any weight now. Because the sense that we have is that that's exactly what FinCen is looking for. Now that all SARs are filed electronically, and they have these sophisticated algorithms that do cross-checking and pull the data apart from these reports, it appears that what they're looking for is more data points. Because the more data points you have, the greater the likelihood that you've actually stumbled on something that is truly suspicious activity. And so this becomes the manager, unlike a money transmitter who knows I transmitted $15 million today to this account, but doesn't know anything else. The manager knows that he went after and solicited Mr. Smith from the Cook Islands to make an investment. And Mr. Smith came up with, a cash account out of a Panamanian bearer bond account, and the asset manager can tell the story. And so all of a sudden that data connects the dots. So if the industry is going to be successful in having these rules delayed or sidetracked, it's going to have to come up with something else other than, I think, duplicative reporting. Myles, your firm is cross-registered as a broker-dealer, correct?
Correct. I mean, my view about this is that SEC-registered investment advisors alone have probably been adopting AML programs from their inception only because it's good business. And if you're a registered investment advisor to a private fund, then for the most part you already need an AML program because the administrator for your fund is going to require you to do some sort of due diligence or KYC prior to submitting the subscription documents to them, and the administrator themselves put it through a substantial AML KYC program. That's why when it was first proposed, I wasn't really jumping up and down about it because in my case, and in cases of the funds that I'm familiar with, they already have pretty robust AML programs already in place.
But what they don't do is they don't file SARs generally, and they don't necessarily keep monitor accounts or transactions and keep reports and records. I mean, they do the KYC and the AML originally, but that's it. The other important thing to keep in mind in this is the AML release says that securities fraud is considered a crime, a predicate crime, where the proceeds of it that go through the financial system are a form of money laundering. And that means that those proceeds are now subject to forfeiture. So theoretically, if you have the fruits of a insider trading scheme that are now flowing through a fund, they don't have to sue the individual anymore. They just sue the money. And it's an in rem action. They go after the money at whatever account it happens to be, whether it's in a hedge fund under the control of the manager, and they seize the money. And then you argue about whether or not there was a predicate offense.
Right.
And so this could very well be a end run around having to prove the predicate offense, and you essentially seize the money or the proceeds of the alleged offense, and then you fight about it later. Because I think, one of the natural consequences of making asset managers subject to the AML reporting rules is that now they need to understand every dollar that's in the accounts that they manage and where it's from and whether or not it could be the proceeds of a crime.
Right. They have to make sure that they can document the source of funds. I believe a majority of them are already doing it only because the regulatory environment has become quite, let's say, stringent recently when we see things like the AIFMD, when we see certain jurisdictions having specific rules and regulations about the marketing of private fund interests in their respective jurisdictions. So I feel that private fund managers, advisors to private fund managers, are probably already doing some of this already, and if not, then they should really work with a firm like Pepper to put in place the adequate AML. And one side note, and I don't mean to digress, but as you know, cybersecurity has become an extremely hot topic for registered investment advisors and broker-dealers, and part of cybersecurity is looking at any AML consequences. And, for example, if you have an identity theft breach, that is a situation where you would have to file a SAR. So if not for the recent FinCen proposals, just for cybersecurity alone, firms should really be tightening up situations regarding identity theft, privacy, and AML.
Yeah, and the important thing to remember, too, about SARs is it's a crime to disclose that you filed an SAR on someone.
Correct.
And including to the person that you filed it on. And so you need to be extremely careful as to who in your organization has access to the SAR files, number one. And number two, if you have any type of volume, you're looking at potentially hundreds of SARs a year, especially if you have a retail-type clientele. One large bank that was represented on our program last month said that they were filing 20 and 30,000 SARs a year. So if you take that number and you divide by 50 weeks in the year, you're looking at hundreds of SARs a day. And even if these things are only a paragraph long, you need an army of people to be able to file them with any type of diligence and correctness. Truly an amazing requirement, unfunded mandate that we've all been asked to address. So our last topic for the last 5 minutes or so of our program is the concept of the outsourced chief investment officer, or outsourced CIO. And we've been hearing a lot about this, particularly cost-conscious endowment accounts and other special investments. And, everybody thinks that by not having the CIO, they can save all of this money. I guess I'm a skeptic. I don't really see how this changes much. It just means somebody else has the fiduciary duty of picking whoever the outsourced CIO is. And worse, the board or trustees or whoever it might be is now stuck with the investment decisions made by essentially an independent contractor. So let's talk through, some archetypical outsourced CIO models. Can the fiduciary risk associated with investment selection be allocated? Probably not under the federal securities laws. That would be considered a hedge clause, and whoever was the ultimate responsible person would still be liable for the acts of their agent, the outsourced CIO, in the same way as if that CIO were an employee of the firm. I don't think it changes an ERISA trustee's responsibility or liability. As a fiduciary of the plan, they still are responsible for the actions of the agent, whether it's an investment manager, an administrator, or what have you. So in terms of fiduciary risk of a investment strategy or plan, I do not believe outsourcing it to a CIO who's not an employee of your firm changes the fact that you have a fiduciary duty to properly manage those assets. What do you need to look out for in an outsourced CIO? Well, I think that's sort of bundled together with Clause D, which is how is this different from a sub-advisor? And what we need to remind everyone is that the notion of a sub-advisor is that they receive a lower fee for performing a subsidiary or smaller part of the overall bundle of services required for the advisory of a particular pool of assets. The advisor is ultimately responsible for everything that that person does. If you're going to pay the advisor and sub-advisor fee in total to an outsourced person, you still need to understand, is that person a stock picker or a fiduciary or a fixed income picker? Or is that person, that firm, undertaking to manage all of the risks of your organization dealing with investments, such as laddering maturities to meet known and anticipated liability, as you would, for example, in a pension plan? Or has this person simply assumed the mantle of stock picker? So you need to understand what you're getting and whether or not the person who's being engaged to provide the service understands their role. The outsourced CIO role, in many respects, Myles, is like an allocator. And I'm wondering if you have any thoughts on the distinctions that can be made between, a firm such as yours that is a wealth manager versus, the so-called outsourced CIO. Is there a difference, or is it just a new name for a function that's been going on for many years?
I think it is a big difference. I think, it's a chicken and the egg. So you're a small, either wealth management firm or startup hedge fund or private equity fund. You may not have the resources to bring a CIO in-house. And even though there's wonderful tools out there that you can access via the internet to help you make investment decisions, nothing's going to take the place of an actual individual who could speak with clients and help you through that process. Now, on the other hand, the problem is that person isn't yours. That person belongs to another firm, or they may be a complete independent contractor. So I am supportive of the role of outsourced CIOs as long as the clients understand exactly that they are an outsourced CIO, and also that the limitations are worked through by both the CIO and the firm itself, because it's the only way that you're going to get that type of, let's say, feature or that type of individual working for you if you can't afford it elsewise.
So there was a method to my madness with starting with the risk and due diligence and not focusing on duties, because I think your answer is that it really depends on how you define the duties that this person is being expected to discharge. And,
yes.
And if they will be paying sufficient attention to your investment portfolio, given the size and their other duties outside of your particular firm. So in many respects, I think you're right. It depends on the firm. It depends on the person. It depends on the duties that you're delegating. In many respects, the same battles that were fought 5 years ago over whether or not an outsourced chief compliance officer made sense. And now we've come to the next question of whether or not the outsourced CIO makes sense. The interesting question, of course, is if you choose a big name in the industry, will that big name in the industry give you the objective assessment, or is it more of the same? And I think that really is the battle for a trustee or a plan administrator or the chief executive officer of a firm to decide what's the marginal benefit to be derived, if any, and what's the marginal cost to be incurred, if any, to outsourcing of this particular function.
Right, and the only thing I would say is I would prefer to see a model where the outsourced CIO is paid on a flat fee rather than the percentage of performance involved. And that may sound counterintuitive. I really just want to remove the CIO from any appearance of impropriety or any appearance of conflict of interest.
Now, when you say flat fee, you mean flat basis points of assets under management versus a performance fee?
Correct.
Yeah. And of course, you point out that there are 3 different ways to compensate someone like this. There's a monthly flat fee, so many thousands of dollars per month. There's a basis points based on the assets under management. He does better, brings in more assets because of performance. His fee goes up. And then there's the performance fee, where not only do you get a management fee or something, but you also get a share of the ups transaction. Well, thank you to our audience and to our speakers for attending and presenting, respectively. We are at the top of the hour, and we, again, appreciate your attention and look forward to speaking with you next month. This is Greg Nowak at Pepper Hamilton, and have a great day.